gold is telling us something bad is likely to happen in the world, the economy, or something is going to happen. You don't want to fight this trend. It is clearly up. Bitcoin, it's really lost its luster here. Majority of stocks are slamming into resistance. That's usually a warning sign. The VIX is trading very low. When the VIX is low, it's time to go. That's kind of where gold is headed. I think we're going to see it potentially could actually blow past it.
Chris Vermeulen is back. He's the chief market strategist at thetechnicaltraders.com. And markets are frothy, in his words, he told me. Even Jerome Powell, I'll show you what Powell said in just a minute, and said that this is not a very good valuation for stock markets. What's next? We'll talk about the stock markets. We'll talk about gold. We'll talk about gold miners. We'll talk about Bitcoin. Chris, welcome back. Hey,
thanks for having me, David. Always a pleasure.
Jerome Powell, at a speech in Rhode Island, said that stocks are fairly highly valued. I'm just going to leave it at that. Do you agree?
Yeah, but I think they've been like that for a long time. I mean, I don't know how much I don't think much weight really goes into what Jerome Powell says when it comes to probably trying to time the market or something like that. But it definitely took the wind out of the sails a little bit. We saw yesterday a little bit of selling step in as midday yesterday. And it's carrying over, so it has a little bit of weighting. But overall, the market was overdone yesterday in terms of kind of short-term bullishness in the market. And if we look at the charts, there's some interesting indicators and tools that give us insight as to short-term analysis of the markets. And so if we were to look at my charts here real quick, this is the SPY. And what is interesting here yesterday is I have this red indicator. Now, this red indicator here is our FOMO indicator. This tells us when people feel like they're missing out in the stock market, or in general, investors feel like they're missing out. The stock market has been running week after week. Precious metal space is screaming higher, leading the way. And of course, there's certain thresholds. Things finally hit yesterday. This is on a 30-minute chart. This is a very powerful tool, though. When this indicator hits this above this blue line, this is telling us people have extreme FOMO. It means they are jumping into the market. They can't take the pain anymore. They either want more stocks or precious metals, or they're not in and they're getting left behind and they're just like, I have to get in. And I did a little tweet there yesterday talking about how the market was about to go off a little bit of a cliff here and sell off just because we hit this threshold. This is a really critical threshold, only short term. This is only for a couple of days. And we've seen the market pull back. And this is what people need to understand too, is pretty much all the markets are related in a way. And when the broad market, David, hits an extreme level of sentiment, which is either panic selling or FOMO, fear of missing out, it really echoes through and moves a lot of different things. So we can see the stock market sold off. This is the same with the Russell 2000, the NASDAQ, and all of those things. If we look at the price of gold, we can use the GLD ETF. We saw gold also move down. If we look at gold miners, they also have sold off from these levels. And so this is like one of the key things that you and I always touch on, or that I try to touch on, is like, if you can understand the sentiment, the money flows in and out of the US stock market, more so the S&P 500, and have these little tools to get a read on investors, it's almost like you're playing poker with players and you get to look at their hand. You know what they're thinking and what they're kind of doing. And understanding the overall ebbs and flows in and out of the stock market will move all these asset classes. So these little tools are really handy. And of course, this coincided, I think, with the comment yesterday with Jerome Powell, and it leads into kind of this selling. But the markets are moving very, very nicely across the board. It doesn't matter if it's gold miners going from a little oversold dip and then hitting this FOMO kind of short-term top, or if we go to the S&P 500 or the NASDAQ for that matter, it's doing pretty much the same thing. When we zoom out, we can see the markets hitting oversold levels. They get bought up and then they go into a short-term top. So in the grand scheme of things, the market needs a little bit of a pause and pullback, and that's what it started. And that's all it is. The trend is still up. We need to let the market just take a breather before potentially it pushes for another leg higher.
This is an interesting post that I saw on Reddit, and this was dated a couple months ago. The research was from last year. I'll just share this with you. So I haven't verified the numbers myself, so I'm not saying this is absolute truth. I'm just pointing this out, that someone has looked into this. Apparently, the S&P has spent about 44% of trading days within 5% of all-time highs. So this is a chart or a table showing what percentage of the time it's spent near all-time highs. So at all-time highs is 7%, and then 12% between 0 to 1%, 1 to 2%, 3 to 4. So if you tally from at all-time highs to about 5%, it supposedly adds up to nearly 40%. Yeah, something like that. So, I mean, that's a pretty incredible number when you think about it. Almost a fourth of the time since 1952, the S&P has been trading near its so-called all-time highs at the time. So the grander question is, again, I haven't verified the math, could be lower, could be higher. But the bigger question is, does it really matter when something is trading near all-time highs? Should we actually be worried? Another way to look at it is, if something is at all-time highs, why would you want to sell it, right? Because if definitionally speaking, if something is an all-time high, the previous day was the all-time high, so it's going up. Yeah. So
you make a really good point.
Yeah.
So I was speaking to an investor yesterday, and well, to answer your question, if something's at an all-time high, you really shouldn't be looking to sell it, simply because it has no overhead resistance. Everybody's winning on the trade. And really, there's going to be minor pauses and pullbacks, which is nothing more than little bouts of people saying, you know what, I'm going to lock in some profits here. And when some people start to lock in profits and there's a little bit of weakness on the chart, other people might say, well, I'm going to lock in some too. So you should, if the trend is up, you should not really be looking to get out of it or to pick a top. You really want to let that trend mature. And all-time highs is really the best spot to be, because there aren't any overhead resistance levels, pockets of shares that people bought previously saying, hey, if it gets back up to this level, I'm going to sell it and get out at break even and move on. All-time highs is a great problem. So I think you just need to stick with the underlying trend and continue to ride this market until proven that it has changed direction.
I want to come back to the S&P 500 in just a few minutes and get your ultimate outlook for, I guess, the rest of the year, given the recent moves, and then levels to watch for. But let's switch over to gold for now before we come back to the S&P. So stay tuned for Chris's prediction for where stocks are headed from here. Gold is another asset that's also hitting all-time highs. In fact, it's been going up so dramatically that a lot of people in the gold space I've been talking to are, quote unquote, a little frightened at how fast it's moved. Almost everyone, not pretty much, everybody who's been bullish on gold has had their expectations beaten this year. With gold at almost $3,800 an ounce, we're looking at $3,773 right now as of just shortly after noon Eastern time. It's a pretty incredible price, especially considering how fast it's moved in such short an amount of time. The GDX, the Gold Miners Index, which we can talk about in just a minute, is up 20% in just a month. So I think it's up more than 90% year to date. Yeah. I'll let you comment on whether or not this is just FOMO buying at this point. And again, all-time highs, why should we be selling the top? I'll let you answer that.
Sure. Yeah. Well, there's definitely been a very nice run. I mean, just looking at the gold chart of this last consolidation and then this run up to this bull flag pattern, using technical analysis, Fibonacci extension, gold has had a perfect move so far. So just based on the way the universe works, using Fibonacci sequence, we have a move up, we have a move down, and based on Fibonacci sequence, we should expect price to run up to the 618. This is called the golden ratio. If you don't know much about Fibonacci, go look it up. It is extremely powerful. And my general rule is if price pauses at the 618 level, then we almost always go up to the 100% measured move afterwards. So I have about 4,100 as the next upside target for gold. We've had this nice run. You and I actually talked about this level last time we were on. And that's kind of where gold is headed. I think we're going to see it potentially hit 41. It could actually blow past it. But you make a really good point, David, that, we have seen this massive move in the precious metals space. In the monthly chart, gives us a really good view of just how much this thing has screamed higher and how much gold is telling us something bad is likely to happen in the world, the economy, or something is going to happen. People are moving more so, they're kind of moving away from the stock market. Even though the market's going to all-time highs, we're definitely seeing the majority of money moving into physical gold. Ray Dalio was on Diary of a CEO, and he was talking about there's like 5 forces and this 80-year cycle that's at play. And we're coming to this major turning point. We've got internal conflict. We got the left fighting the right in extreme ways. We've got people not trusting the systems anymore, that the government's protecting them. We've got currency problems. So gold is a good representation that we're about to go through this huge life cycle. And it's telling us, physical metals is the place to be. We're in that perfect storm for metals. But we do need to know that when things go parabolic, as you said, and they start to shoot higher, it can end very abruptly, and it might have a big pullback. And a good view of this, we can come back to this chart after if we want, but look at GDX. Look at the large cap gold miners. This is called a parabolic move. It is just going straight up. If we look at silver miners, we have the monthly chart. They're shooting straight up. And if you notice what happens after every straight up move, usually it ends pretty abruptly. The question is, when is it topping? These things are at all-time highs. There's no need to get out yet, but you need to be mentally prepared that, hey, if this does turn, it is kind of a crowded play now, that people could unload and exit very quickly and create a very sharp drop. So this is like the bit of the warning sign that when things go straight up, and like I have this huge wave right now of people emailing us and talking about they have FOMO. They want in. They're asking me what stocks and what precious metal ETFs can they buy to take advantage of this. And really, those are the people who aren't in, and now they're willing to pay a premium. They're willing to pay nosebleed pricing, and usually that's a sign we're close to a top. And if I say anything negative on the precious metal space, like we might be coming into a little bit of a blow off top here, I'm going to get my my head ripped off in the comments, which is fine. But that's one of the indicators that everybody says gold is going to the moon. This is totally different than last time, and every time it is a bit different than last time. But the signs are here. When you look at price action, you don't want to fight this trend. It is clearly up, but this type of move usually ends in a very abrupt reversal and a very long red candle and catches a lot of people off guard. So, it doesn't matter how you look at the precious metal space, money is dumping in. And one other quick aspect here is platinum and palladium have both exploded. We have platinum taking off. And if we look at palladium ETF, these are just the ETFs on them. They have really popped and taken off in the last few days. Palladium, not quite as much, but everybody's just moving into all things precious metal right now. They don't care, and they're piling in. And you just have to be aware. It feels a little crowded of a play. A pause or pullback, depending on how it does that, could be a very bullish sign. It could be an opportunity to get in or add more before it goes higher in the precious metal space. But if it's a reversal type of candle or pattern, you might want to buckle up and protect some profits, because it might actually have a bit of a precipitous unwinding event as well.
Crypto has been heating up all summer. Bitcoin has continuously surpassed new all-time highs, while Ethereum gained more than 50% in just a few weeks since the beginning of the summer. Is it altcoin season? What's going on? Well, institutional flows continue to pump while retail investors are coming back into the space. But with so many new products and platforms, it's difficult to keep track of all of them and know where to begin. That's where today's sponsor 21 Shares comes in. They offer a simple way to gain exposure to crypto through fully backed ETPs. You can access their products right from your brokerage account without worrying about wallets or private keys. 21 Shares covers everything from Bitcoin and Ethereum to layer 1s, DeFi, and thematic indices. They even publish in-depth research to help you understand the space. If you're interested in adding crypto to your portfolio in a way that's accessible and registered, visit 21shares.com, subscribe to the newsletter, or follow them at 21 Shares and at 21 Shares_US on YouTube, Instagram, and X to stay up to date on their updates. You're not going to want to miss them. They're a good starting point if you want to be in the market but stay on the rails. Go to the link in the description or scan the QR code here
to learn more today.
Chris, the notion that something that has gone parabolic usually goes straight down, is that always true? Can we think of cases in which it goes parabolic and just stays there consolidating for quite some time before any movement is realized?
Yeah, it can. It could go, very parabolic and then kind of trade sideways for a while and build a launch pad. And that's a good thing. If it can do that, that's great. But typically a parabolic move usually represents whoever's going to get into that asset has got sucked in. They got in because of fear of missing out, greed. They want to get in. They want to catch it. Usually the parabolic moves lure everyone in. And so there aren't a lot of buyers. When it does start to reverse down, everybody who's going to get into it has already got in. So it's really just left with all those people now worried they're going to lose money if they hold on to it. And it can hold its ground. It can, but it generally ends in a pretty strong kind of reverse to the downside.
Just on the GDX going parabolic, I was just attending a gold mining conference in Colorado 2 weeks ago. And I asked all the miners that I interviewed there, how's M&A activity? How's finance activity now that your stock has pretty much gone parabolic this year? Have things picked up on the financing front? And the answer is yes, just a little bit.
Right.
And it's just interesting how there's a big disconnect between the valuations and stock prices of these companies versus actually what's going on the ground. Their drilling activity is still resuming. I mean, it's not. We're not seeing an explosion of new discoveries because of these valuations. We're not seeing an explosion of new M&A activity. There was a big merger between Anglo American and Tech Resources. That was a major merger announcement 2 weeks ago. But on the junior front, projects are just being picked up. It's not, activity isn't super high. So what does that tell you when institutional investors are just starting to look at the space now at these valuations, according to the people I've talked to, that finance activity is just starting to pick up a little bit now, that M&A is just starting to pick up a little bit now, and the index has gone up nearly 100% year to date.
Yeah, I think there's a couple things at play. When you look at like private equity, you look at like venture capital money. Man, that's spigot shut off a few years ago. It just dried right up. Investors are worried to take on risk, and there is this weird investment vibe that people are. It's more difficult to raise money still right now, and I think that's why a lot of these potential mining stocks are struggling. They have been dormant for a long time, and we're not in an environment where money is just pouring into opportunities. So there's still that the investment vibe is still very conservative. They don't really want to take much risk. Second, I think the miners have exploded so fast and have big gains that I think a lot of investors are like, well, I don't really want to invest right now because it feels like it's like fairly valued or high valued. They'd rather maybe get into it after it's had like a pullback or something. So they're like, how much more upside is there if the prices have gone parabolic and they're all at resistance or just poking into nominal new highs? It's, savvy investors don't really want to invest after a massive rally. Like that's kind of, when it comes to private equity company, they're not like individual investors who chase high prices. They generally are looking for opportunity, and they don't really want to invest when they're like, well, it just doubled or tripled that individual stock. I kind of don't feel like investing in it right now because I feel like I'm paying a premium, right? So I think there's those two plays in the precious metal space kind of making it maybe difficult to raise some capital.
I know your strategy quite well after working with you for several years now, but for the people new to your work, you're not trying to chase a top or a bottom, right? That's not what you're trying to do?
No, more or less, I try to identify trends in the market, substantial trends. We're looking for, I always use the analogy, like I look at the stock market like the ocean. If we look at a long-term, this is the weekly chart of the S&P 500, you need to know a couple things. From a long-term investor standpoint, you need to know, are we in a bull market phase? The stock market is going up, or are we in a bearish environment where the stock market is going down? So there's a time to own stocks, and there's a time not to own stocks and to move somewhere else. And I use a strategy called asset revesting, which is we reinvest our capital into whichever asset is favorable. And so, we've had a series of these bull and bear market phases, and we're back into a bullish environment. So you need to know if the tide is going up or down. That is number one. Number two is if you go and you look at the stock market from a daily chart, this is the QQQ, you need a strategy that catches these waves through the markets. And I like to think like we kind of surf the markets. Every year, there's about 5 to 12 waves that roll through this bond market, stocks, and various assets. And we want to know when a wave is ending based on technicals and money flow. We want to know when a new wave is starting. And so we're able to just move in and out of the asset classes. We exit the QQQ. We move into a different asset to grow our capital as the stock market falls. And then we can reinvest back into the stock market. And we can play these waves in the market. And so that's what I do. I focus on ETFs. We have 5 to 12 trades a year. We're just rotating from stocks, bonds, currency, cash, and back and forth, just whichever one is kind of moving. And when you go back to 2022, the stock market fell over 20%. The US dollar ETF rallied 17%. And, you want to move to an asset that's going up. Investors, you shouldn't be holding things going down. So that's what I do. We rotate through the markets. We play these unique market scenarios. And, we're getting to this level in the stock market right now that this is earlier this year, just before the tariff sell-off in the NASDAQ. We had this unique market sentiment setup. And this color coding here is using a bunch of different technicals and cycles and money flows. We have a very similar chart pattern unfolding right here that is telling us that we're potentially getting close to a bigger pullback. There's a big disconnect going on in the stock market. And so I'm very cautious here of what we're going to do. We did lock in some profits on our trade last week. So it doesn't matter what happens now. We are long stocks and gold, and those are the plays, but we just need to be aware that these markets will rotate. We have these waves, and you can take full advantage of this market if you understand how to identify these. And it's the same with gold. You can move in and out of gold or the dollar. And I think gold has got some pretty good potential to the upside still.
So let's talk about that. How do we know that this is still a bull market? I think that's a common question. So let's take gold, for example, to illustrate this point. Gold's already up 100% since 2023. So in less than 2 years, it's doubled. How do we know at this point that it's in still a bull market? Like you said, more room to climb, or we've reached sort of a pivotal inflection point. Do you look at momentum indicators? Do you look at the pace at which it's growing? Do you look at other asset classes that may or may not move alongside gold as an indicator? What do you do to make that assessment?
Yeah, well, there's a few layers in there. The number one thing is price action. Is it still trending higher? More or less, I don't have the 150-day moving average, but I can actually convert this one over to one. So if you were to take a look at like a 150-day moving average, generally, if price is above the 150-day, which is the blue line, and the blue line is sloping up, you're generally in a bull market environment. So, you need a lot of damage in gold. It needs to trade sideways for a long time.
Just on that note, I thought that, maybe I'm reading this wrong, but I thought that whenever something is trading above the 150-day moving average, or even the 200-day moving average, it's usually a sign that you should be selling it because it's just overbought. Is that not the right way to look at it?
No, I don't think so. Generally, the 150-day moving average is telling us the long-term cycle, the long-term money flows. You want price above it. When price is above it, it means you're in a strong long-term uptrend. There's a big tailwind. And along the way, there'll be a series of rallies and pauses where it rallies up. It gets a little too far above the 150-day. It'll take a bit of a breather. It'll rally back up. It'll take a breather. It'll rally. So you want price above the 150-day moving average. In fact, you want it really above the 50-day as well, the short term. But as an investor, the key is to identify on how long of a picture you want to focus on is when do you decide it is in a new downtrend and to get out. Now, I think gold would have to have a lot of damage to kind of signal we're in a bear market. Is probably going to have to you break below this level or break even below this level before I'd say, hey, gold has put in a massive top. If it sells off and puts in a head and shoulders or a bearish pattern and then starts to break down. So you don't know. A bull and bear market require a lot of time and a lot of price movement to really shift that trend. And I mean, I don't trade so much on the bull and bear market side because there's a lot of volatility in there. I focus on the shorter term daily chart and the 20-day moving average. So the key, though, is just identify the price action. Is price making a series of, on average, higher highs and higher lows? And if it is, then it's in an uptrend. If it starts to make lower highs and lower lows, lower highs and lower lows, then you're in a downtrend. So price is the number one indicator to figure out which way it's going. And then you need position management. If it drops to a certain percentage, you should get out, protect your capital. But really it comes down to price action. And you just have to decide, like, are you like a short-term swing trading strategy? Are you like a position trading strategy, which could last a few months? Or are you a long-term investor really going for that bull or bear market type of trends only?
Right. I think the reason I asked that is because so many people have told me that markets tend to revert to the mean, so the mean reversion theory. And so when something's trading at above the moving average, the 100-day or 250-day or 200-day, whatever the case may be, for an extended period of time, usually we're looking at some sort of mean reversion thereafter. Do you have any thoughts on this? Does this theory have any credence in actual practice?
Well, I mean, if something gets overextended too far away from a moving average, usually it wants to pull back and revert back to the moving average. You can see, like, a good example is, well, the S&P 500 doing this right now, but the 20-day moving average, gold likes to move up the 20-day moving average. Most assets do. There's a 20-day kind of cycle that goes in there. Look at the S&P 500 since the lows in April. It just bounces up the 20-day. So this is kind of like the reversion to the mean. It wants to just take a bit of a pause or breather, find some support near a moving average, and start to bounce higher. And gold has been doing that. When we look at the long-term picture chart of gold here, you can see that when it does get a little far away from the 150-day moving average, it trades sideways for a while. So the 150-day can somewhat catch up. And then it gets stretched a little too far away, and then it takes a breather, lets the moving average, it needs time to consolidate. And so it just kind of happens over and over again. This is very bullish price action. You want to see price rally, pause. These are a series of what are called bull flag patterns. They point to higher pricing. They give us upside targets. So just because it's above a moving average doesn't matter. Maybe if it's too far. If you go back in time and say every time gold rallies, roughly 15% from that moving average, maybe it needs to revert to the mean. It needs to let the moving average catch up. We could go back over here. Here's another, 15, 12%. It has a multiple series. As I move up, the values change, but you kind of need these same levels, right? That's how I would look at it.
This is another interesting chart that I saw floating around on Twitter. And we can verify this with our own charts here. I'm just showing my screen real quick. This is just S&P 500 versus gold. So we're talking about stocks and gold now so far. Since 2023, gold has been outperforming, but in particular, it started really outperforming this year. Now, the question is, what does it mean when you've got a bull market in stocks, but at the same time, gold, traditionally seen as a less volatile safe haven asset, is outperforming? It's not like the stock market is crashing and then gold's just flat and outperforming. That would kind of intuitively make sense. But gold is beating risk on right now. And if you take a look at, you can do this on your own screen as well, but if you take a look at, I'll just show you mine real quick because I have it up. Just comparing these two, the last time gold spiked up was in 2020, 2021. And if you just zoom in that period, everything was going up at the same time. Stocks were going up, cryptos were exploding, as you know. And between 2020 to late 2021, you've got a period in which the S&P was up 40% and gold was up 20%. Not bad for gold, but still not outperforming the equities index. But now the reverse is happening. And like I said, stocks aren't crashing. So what does this signal to you? What is the market trying to tell us?
Yeah, so you and I have touched on this. Hopefully people can wrap their head around this chart. It's a little noisy. So this is a good example of kind of what you're talking about. 2007, the stock market topped. We saw the candlestick chart in the background. That's the S&P 500. And I've drawn lines to where the stock market put in a top. Gold was screaming higher. And we have the stock market at all-time highs right now. Gold is screaming higher on our current chart where we are. eventually, if the music does come to an end here and we see some type of reversal, some event hits and we see it roll over, we could see the stock market sell off fairly abruptly, but gold can keep shooting higher. And that's why I really like gold, is because for the first wave of massive selling of bad news, whatever's going to hit the market, gold is seen as that safe haven place. So I think we still can see a big push up in gold, 4,100, maybe even 4,500 for gold. But I do think eventually we could see a very big market correction. And the green line on here is the dollar. And of course, the dollar is trading, at very big lows. It's very much hated. It's the same where we are right now. We've got the dollar trading down. Nobody likes it. Everybody thinks it's going to be worthless. But I think somebody told me yesterday or this morning actually about, I think the administration was talking about, they gave like the green light for World War III, which I'm not caught up on that, but they were saying how it could spark the dollar to become very strong. And the dollar has put in a very strong bounce and rally, especially if you're a Canadian investor. It's looking pretty good for a Canadian investor that the dollar is going to strengthen, the Canadian dollar is going to weaken. So you want to hold US dollars. But anyway, we could see in chaos, in difficult times, the US dollar does tend to rally. The US is still a powerhouse, and the dollar seems to shine when there is massive uncertainty. So, I mean, when you look at it in a nutshell, when gold is outperforming, just like you mentioned, in fact, our infographic shows here, precious metals tend to perform the best right near a major stock market top. And that's what we're seeing. And even if we look at the business cycle, which this is where I think we're coming into a big, some type of weak economic cycle, something I think is going to hit that causes a problem. We're in this innovation and adaptation phase. The innovation right now is AI. And AI just happens to be the largest tech companies dragging the indices higher and making it look like this market's really strong. And this usually happens just, right near a major stock market top. And a good example of this, David, is if we take a look at the IWM. If we take a look at the IWM, this is the small caps. They are testing and trading right up near all-time highs. We're putting in potentially a triple top for the majority of stocks. And this is why everybody's really bullish right now. They're piling into small and micro cap stocks, trying to make as much money as they can. And people don't realize, like, every time we've gotten here, we've seen a huge sell-off. The other one is IWC, which are the micro caps, even more aggressive traders. It is coming right up into a significant resistance area from 2021, when everybody else was piling into all these to make as much as they can. Like, aggressive traders are moving into these. It's not a bad thing. I mean, people want to move to where the money is, but we also need to know it is running into resistance. And if we look at the equal weighted S&P 500, which is that is the RSP ETF. So this is the S&P 500 without the big tech heavyweights. We're kind of pushing in. Let me just zoom out a bit here. We're pushing right back into these highs that we saw just earlier this year. Let me just zoom in, and it's starting to look like it's stalling out. So the majority of stocks are slamming into resistance, and everyone is really bullish. They feel like the market's going to scream higher. That's usually a warning sign. And when we look at the VIX is trading very low. I'll go back to the daily chart here. If we look at the VIX, when the VIX is low, it's time to go. There's not a lot of fear in the market. And the biggest thing right now as a short-term indicator is the put-call ratio. Now, the put-call ratio, this looks like a noisy, messy chart. People are like, how do you even look at that? The key for this really is just to look at the 5-day moving average. Whenever the 5-day moving average gets down to this lower level, and it's actually much lower than it typically gets, that's telling us a lot of people are buying call options. They are betting and using leverage for higher pricing. And that's what everybody's positioned for right now. And it's a contrarian indicator. When everybody's long all the aggressive stuff, now they're buying options on it. Usually we're going to see some type of bit of a pullback. And that's what I think we started to see yesterday. I think we hit that FOMO extreme. Everybody just who couldn't handle missing out on the rally for metals and the stock market got in yesterday. And I think the big institutional players, they started to sell into it. They're like, okay, we just hit that threshold. Let's start to sell into these people who feel like they have to get in. And these indicators tell us we should expect some short-term weakness in the market.
So looking at the future for gold and stocks, you said that they both have some upside for now. Which has more upside? And we'll get your levels from here.
I think gold has more upside. Believe it or not, the charts of silver and gold have roughly the same upside potential. So I would naturally go say we'll trade gold because it has a higher probability of hitting it and it has less volatility, meaning you don't have to ride quite the roller coaster, which means you can put more money to work. And you can make the same amount of money as silver, more or less. People don't want to hear that. They naturally think silver outperforms dramatically, but really this year, silver has only outperformed gold really just like 8 or 9%. And it has been a hell of a roller coaster ride if you hold silver. So gold to me has got the most. I think it's got 15 to maybe even 30% upside from where we are right now. The stock market, I think it might continue to grind a little higher if the big techs can keep dragging it up. But small caps, mid caps, more or less equal weighted stocks have all hit resistance. So it needs to be the large tech that drag the markets higher. And, they're not showing the strongest kind of sign right now. When we look at the MAGS ETF, let me see here. The MAG ETF is clearly in an uptrend, but it is actually showing a little bit of weakness, short-term weakness that it might want to pull back a little bit. So I think physical gold or a physical gold ETF is the play. And that's where the opportunity I think lies right now.
What are the, just on gold itself, what are the critical levels we should be watching for? So below this level, if it breaks a certain floor, we're looking at maybe more downside action. And then do we have a ceiling here? Yeah,
the ceiling for gold, the next level is about 4,100, 4,080, 4,100. So that's kind of where we should be looking for that next upside target. If we look, it's about 9-10%. That's a Fibonacci measured move where it should run into a little bit of resistance. But what happens in this market environment, which when we look at 2007, the comparison, this is where gold could not only hit that target, but blast past it another 15-20% or so. So I do think, that is the gold target, 4,100, but we could have a parabolic move where more people pile in and it shoots higher. And that'll be money probably flowing out of the stock market. We'll probably see stocks falling, and that fuels gold even more. Because first of all, gold's on fire. If the stock market starts to fall, people now don't have to split their money between stocks and gold. They're like, get me out of stocks and I'll put it all in gold. So that first initial big bout of selling in the stock market, that fear generally shifts all that money and dumps it into gold. And that's what gives that final blow off phase for gold. That's when you need to be aware we might see like a sharp reversal. But I still think there's quite a bit of upside in the precious metal space for gold, silver, and miners. I don't think I'm not saying it's topping right now. I'm just saying we're getting into this stage where it's very favorable. It could keep moving fast, but you just need to have a game plan for when we hit these capitulation levels. Locking in some partial profits isn't a bad idea.
I'm just smiling because time flies. When I first started in this business a few years ago, in 2020, I first started doing interviews. 4,000, 5,000 gold headlines were like seen as like clickbait. I put that there to make people think, well, that's a crazy title. I should click on that. Now it's a 9% move from where we are today. Yeah, time flies. And I remember people telling me, well, if gold goes to 5,000, it means we're all living in bunkers and we're all living on canned food and ammo and stuff, stock up on guns. Yes, there are wars going on in the world. Yes, people are suffering, but here in the West, where we're broadcasting from, I'm not seeing any of that. It's just a natural progression of where financial markets have taken us.
Yeah, so I think there's enough chaos and instability around the world and countries right now. Yeah. People are moving to big, solid investments, physical, get them, reduce their exposure to the financial markets. And
Okay, let's move on to finally, before we close off, I want to touch on your S&P 500 targets. So let's do that.
Sure. Okay.
Same question that I asked you about gold, I'll extend to stocks. So key levels to watch for.
Yeah, when we look at the equities market, so the S&P 500 for an upside target, I mean, if we were to look at big picture analysis similar to gold, if we were to look at the really big pictures, there's still quite a bit of potential upside on the S&P 500. Now, this is showing we could see, this is the SPY ETF, which I probably should have used the futures, but overall, if we were to just zoom in on the price action here, you can see there's an upside target around 680 SPY. So this target is showing us we've got about 3% upside. And this is based off let me just get this back down here. This is based off a very significant low back in the 2022 kind of market bottom, 2023 little pullback here. Based on this, there's about 3% upside, not a whole lot, which is why I like gold. If we take a look at the QQQ, this one's kind of interesting too. If we look at the QQQ for the same type of thing, we have the QQQ hitting resistance like a day ago, 2 days ago, hitting that 100% measured move. And as you know, if you hit the 618 level and you have a pause and a hiccup for a while, you generally always go up and hit the 100% measured move. So we've now just slammed into that. We had the FOMO indicator hit an extreme yesterday. The market literally pivoted within the hour, and now we have some selling pressure going on. So this is why I was saying the Magnificent Seven need to do some serious more heavy lifting to drag these markets higher, because everything is pretty much running out of steam into resistance. Small caps are at resistance already, as I showed you, and the micro caps. So, the S&P 500 has the upside, a little bit of upside, but the precious metal space is definitely kind of the play at this point. I think you still need to be long equities. We're long equities. We can still go higher, but you're asking for where the next upside targets are. Now we need to see a little bit of a pause or pullback to kind of get a gauge of where the next short-term move will be going forward. And, you wanted to touch on Bitcoin. We could touch on that real quick. And it's really lost its luster here. It's always talked about as being the digital gold, and it is far from that at this point. It's really been going down as gold and the stock market has been going up. And I think Ethereum has taken over, has taken a lot of the money flow. And I think a lot of people who were in Bitcoin are reverting back to getting into gold, silver, and miners. They want to get into that space. So overall, I would just steer clear of Bitcoin temporarily. It's got a kind of an ugly chart at this point. I think the precious metal space is still is kind of the one shining right now.
Okay, great. I'll put the link down below so people can follow your work there, and just give us a synopsis of what we can find when we do go to that link.
Sure. Yeah. If you go to my website, my whole focus is helping investors avoid big bear markets and to take advantage of bull markets. And really, I just manage my own portfolio. I share my ETF trades. Again, there's 5 to 12 portfolio adjustments each year. We move into stocks, bonds, currencies, or cash. We just rotate, as I showed with the red and green chart, with our signals on the stock market, where we know when to get in, when to get out, and what asset to shuffle over to. And of course, you just copy my trade signals. They're end of day. So when you get a signal, you get it at the end of the day. You have all night and all morning to get in. We enter positions the next day at the opening bell, and I provide portfolio allocations, our stops, our targets. We walk through it every morning. I give a video update on what's going on, so you can navigate through these markets. And we just consistently watch our account move up and to the right. Doesn't matter if we have a 2008 bear market or financial crashes or COVID or the 2022. We're constantly only holding an asset going up, or we're sitting in cash collecting interest until there is something worth holding. And it allows us to really get a high annualized return, very little max drawdown. We don't have to carry the risk of worrying about blowing up our retirement accounts or anything like that. And really, you're just copying the trades that I do. So I don't dish out trades to satisfy people. I literally just share the exact portfolio allocations and trades that I do, and we trade together. So that's it in a nutshell.
Excellent. Thank you very much, Chris. We'll put the links down below. Follow Chris there, and we'll get you on in a couple weeks to give us another update soon. Plenty more volatility to talk about. Let's see where gold and stocks and Bitcoin end up. We haven't talked about Bitcoin today. We'll do so next time. Thanks, Chris.
Thanks, David. Take care.
Thank you for watching. Don't forget to like and subscribe.